Thank you very much for attending today. My name is Alex Herbert. I'm one of the senior partners at Holborn. I'm going to introduce Richard Burden of Canaccord Genuity Wealth Management, and he will introduce Justin. We've run a number of these webinars over the last 18 months, and it's always exciting to hear exactly what Justin's and Richard's views are on the markets and what's happening right now. And with that, we'll have a question and answer session at the end of the webinar. There is a Q&A button at the bottom, so please feel free to type your questions during the event, and then Richard or I will handle those questions at the end with Justin. Over to you, Richard.
Thank you very much, Alex. Good morning, afternoon, everybody, wherever you are in the world. I'm delighted to be joined today by Justin Oliver, the firm's Deputy CIO, who is responsible for chairing key committees within our firm that determine the asset allocation, portfolio construction and investment philosophy of the assets under management that we manage on behalf of clients, which have actually risen to over 33 billion sterling recently. The subject today is China and the economic reforms that have recently been going on there. Obviously, within China over the last 18 months, they've been in the headlines for being the source of the COVID and the pandemic. And what Justin is going to do today is try and look through that at the actual significant economic reforms that they are putting in place and remove a lot of the speculation and hype and see what the impact of this will be on the global economy. As Alex said, we will be running a Q&A afterwards. If anyone has any questions during the presentation, please pop them in the Q&A box below, and I will be putting our emails in the chat function as well if anyone would like to contact us directly afterwards. Justin, over to you.
Okay, thank you very much, Richard. Thank you, Alex, and hello to you all. Thank you for your time today. As Richard mentioned, today we're actually going to talk about two big topics. Firstly, what's going on with China, and secondly, what's happening with regard to US inflation. Now, I think either of these could be a full presentation in its own right. We're probably going to spend about 15 to 20 minutes on China, but I think you should count yourself lucky because we actually had an investment strategy meeting last week where I talked about China for about an hour and a half. And these are just a selection of the slides which I used and we went through last week when we were looking at China and trying to sort of get a better handle in terms of what's going on as far as that's concerned. So we'll touch on China. We're also going to have a look at US inflation, which I think is probably the most important issue which is going to be impacting financial markets. And therefore, I think it's very important we at least understand some of the forces which are coming into play as far as the inflation picture is concerned. But again, realizing there's still a lot we don't know as far as inflation is concerned. There's really no historical precedent for what's happening. So we'll examine some of these issues, but again, we need to recognize that there's a lot to consider. I'm really going to have time just to touch on some of these issues briefly, but hopefully some points will come out which will help us again come to some sort of conclusions in terms of that. So with that, I'll hopefully share my screen with you. And Rich, can you just confirm that's
yes, we can see that, Justin.
Perfect. Thank you very much. Okay, so let's just start the presentation proper. So as far as China is concerned, I think we're going to look at briefly sort of three things. One is the political and regulatory environment. Then we'll turn on to the Chinese economy and then the sort of Chinese stock market. But really, it's in broad terms, it's the first part, the regulatory backdrop, which is having the most impact as far as China is concerned. But of course, it's the area where there's the least certainty and least clarity. But of late, it does seem to have been a profound shift in China's political backdrop. And I think it's important to stress at this early point, it's one that offers the potential for positive structural reform, but also clearly it's bringing with it a period which could be is bringing with it prolonged sort of regulatory uncertainty and state intervention. But to provide that sort of opening summary, clearly the Chinese Communist Party at the moment is developing a model which prioritizes social fairness through its mantra of common prosperity. Now, the old vision that some will get rich first seems to be giving way to something which is a bit more equitable. And actually, that might ultimately benefit the 600 million Chinese who still live off a monthly income of about $154 or less. The problem is, if those good intentions are derailed by radicalism or overkill, then the future for China, I think, will become a little bit more challenging. I think it's also important to stress, the current policy that China is adopting appears to be more than just about redistributing wealth. It's actually about increasing the size and the income of the middle class and sort of boosting social mobility. Now, ultimately, I think those developments do have the potential to positively enhance China's long-term growth potential, but in the short run, the risk of negatively impacting business sentiment and market efficiency shouldn't be underestimated. There's also that separate strand which is going on at the moment, which is focused on national security. So at the beginning of August, China released a 5-year plan, really just to try and strengthen regulatory control over strategic sectors, most notably in the technology space. They didn't necessarily provide a list of specific instructions or measures, but sort of mainly highlighted what they felt was an urgent need for extra legislation, really to govern the technology and also the education sectors, and also to resolve some of those antitrust issues, which are affecting not just China, but also economies in the West. Now, some of those common prosperity moves that we're seeing in China, do you know what? Actually, some of them are to be applauded. So, outlining the controversial 996 overtime policy, by which many tech sector workers were expected to work from 9 o'clock in the morning to 9 o'clock in the evening, 6 days a week, does suggest that Beijing is genuinely trying to improve the lot for Chinese many low-income workers. So limiting after-school tuition as well, could help reduce chronic stress for millions of children. But there are dangers within it. So one of the risks is that the various broadsides against the tech sector in particular, if that continues, then there could be a prejudice against private enterprise, which is nurtured, and almost all the tech companies there, so Alibaba, Tencent, Didi, and the others, that have fallen under that regulatory scrutiny in recent weeks, are privately owned. Now, just taking a step back, common prosperity, it isn't a new theme. It was introduced first by Chairman Mao in as early as 1953, when the aim of lifting farmers out of poverty through industrialization first came to the fore. It fell out of use slightly when the focus shifted more towards developing the economy, which would allow some people to get rich first, and then they could then help those who are left behind, and common prosperity will come later. But then President Xi made it a central part of his 2017 speech at the party Congress, really to mark the start of his second term, and that focus has increased significantly of late. But it's also a clear recognition of what is a wide wealth gap in China. So China's richest 20% earn more than 10 times the poorest 20%, which is actually a wider gap than we see in the US or certain European countries like Germany and France. And that position hasn't really changed since about 2015. So while we have seen the number of people who live in extreme poverty has dropped dramatically over the past decade. So whilst that has happened, there's still more than 600 million people, which is about half of China's population, still live on an annual income of less than $2,000. But at the other end of the spectrum, clearly the rapid economic growth we've seen, the market-based reforms have created tremendous wealth. So China's got 81 billionaires on Bloomberg's ranking of the world's 500 richest people, which is more than any other country after the United States. And there are thousands more billionaires and multimillionaires who didn't crack that top 500. Ahead of its 100th anniversary in July, the Communist Party did declare the completion of their long effort to create a moderately prosperous society. and that it did announce that it eliminated extreme poverty. And really, again, it's that accomplishment which has allowed the government really then to prioritise that common prosperity agenda. Now, to achieve that, the government does need to do three things. It needs to reduce the heavy financial burdens on education, on healthcare, and housing. And those are sort of dubbed the three big mountains for ordinary Chinese. Now, regulatory measures were put in place in the first half of the year to bring sectors from property development to technology and education into line with the new policy thinking, and curbs have been applied on production in high polluting industries such as cement and steel. And working towards those longer term ambitions will, we think, entail some short-term costs for growth, but monetary policy and regulatory relaxation will be used if needed just to try and soften that growth impact. If we're looking at some of those three mountains in a bit more detail, outside of the tech sector, the move which has, I think, garnered the most focus has been the crackdown on private education companies. Declaring that the industry had been severely hijacked by capital. Regulators published new regulations in July, which, amongst other things, required private companies that teach compulsory school subjects to go non-profit. It banned them from going public or raising foreign capital, and it also banned tutoring on some of the core syllabus subjects during vacations and weekends, which was the prime hours for these private companies. And regulators again have fined two of the biggest startups for false advertising. Those are backed by Alibaba and Tencent respectively. On the flip side, tutoring services that focus on cultivating interests and practical abilities like piano lessons are still being encouraged. So I think we need to be a little bit careful about assuming that China's crackdown on the education system is necessarily going to be followed by restrictive regulations applied to virtually every other industry. It's just that the regulators in this case felt that some of the tutoring firms were exploiting paranoia. It's becoming a bit of a marketing free-for-all, sometimes with false advertisements and misleading campaigns. And really, it was just funneling some children into really sort of mind-numbing classes from which there were sort of uncertain benefits. And really, as those student numbers exploded, venture capital investors who didn't want to miss out, joined the party, and that sort of exuberance really alarmed regulators who feared that tutoring firms, empowered by that capital, would only continue to grow, and that would exacerbate the problems that they were seeing in the education sectors. And again, it comes back to the fact that officials are concerned about the effects of hundreds of millions of parents ploughing their life savings into online classes, and also subjecting children to increasingly onerous workloads. So China's really just trying to sort of step in and diffuse what it perceived as could be a potential time bomb, and really really just trying to get a grip on that particular sector. The other point to make, of course, is that many cited the cost and competition for education as a contributor to China's declining birth rate. So China's offered tax breaks, including sort of write-offs for education fees, but that didn't help. Now it wants people to consider having up to 3 children. A reform of the education system was seen as a good way to start. China's also announced reform plans for healthcare in public hospitals, which again designed to keep prices from rising too quickly. China's been tackling healthcare costs for quite a while. It's focused on drugs, and that was actually well before the current lockdown or the current crackdown on technology and education. So starting in 2018, it launched a centralized drug procurement program for public hospitals. It forced generic drug makers to bid for contracts at competitive prices, and actually brought down medicine costs by over 90% in some cases. So actually, we can take a step back and say those are all positive developments, unless of course you're a drug company. But so now in its 5th round, that program has cut healthcare costs by billions. After the third round, over $8 billion was being saved on an annual basis. China's also asked pharmaceutical companies to cut the prices of their innovative drugs by over 50% in order to be included in that reimbursement list of medications that will be paid for by the state medical insurance. And really, it's just the most recent reforms are going to create a mechanism with clear rules governing how prices are calculated and capped at public hospitals, where costs are split between the patients and the state medical insurance funds. So, actually, unlike the recent crackdowns on sectors like property and education technology, this effort actually isn't intended to cut prices across the board. It's all part of a broader adjustment in healthcare, which is now looking just to try and ensure that the costs of hospitals, hospital services don't rise too quickly. And actually, in some cases, authorities said services like pediatric care, nursing, sophisticated surgeries, and traditional Chinese medicines were actually undervalued. It said actually in those areas it needed policy incentives, and actually signaled that their prices could rise moving forward. And then just turning on to property, as we know for years, China's been trying to make housing more affordable, particularly in the largest cities, and has often blamed speculators for driving prices up. There are mounting signs that it's preparing to move on an idea that's been discussed for a long time, which is imposing a residential property tax to try and deter speculation. And that's all part of the mantra, which is housing is for living, not for speculation. And again, it's one of the many campaigns which is being made by President Xi, really as he seeks to try to reduce the cost of raising a family and diffuse risks in the financial system. But it's also been one of the toughest goals to achieve, given the vital importance of the sector to the economy. The property sector accounts for more than 28% of GDP in China. The other thing which is in the headlines at the moment is clearly the likely default of the nation's biggest property developer, so Evergrande, which I think could leave many banks and investors holding significant losses. It is the world's most debt-saddled property developer, has about $300 billion of debt. It's got hundreds of unfinished buildings, and suppliers have shut down construction sites. And the company started to pay overdue bills by handing over unfinished properties. The big question at the moment is, will China step in to save it? Quite frankly, that's unknown, but I think there's a realization that a full-scale collapse would cause serious damage, and Beijing does have form with stepping in to help other large companies with problems in the past. On the other side of the argument, the authorities have shown greater willingness to let companies fail in order to rein in China's debt problem, and so the Evergrande's management have been told in no uncertain manner to try and get that debt in order. But again, lots of things going on in terms of the property sector. And now the big one, the crackdown on China's tech sector. Now that can be ascribed, we think, to two motivations. First is the antitrust side, and second is national security. On the national security side, China's not alone. Governments around the world have recognized the importance of data and the need to regulate firms which rely on data as an integral part of their business models. So Europe's got GDPR, India mandates personal data localization and has clashed with Facebook, clashed with Twitter and TikTok. So China's heightened concerns with data security is not isolated. The US has got export restrictions on Huawei. It's threatened to ban TikTok, and India's clearly banned China's mobile apps. Again, all of those moves have been made in the name of national security. As we know, in recent weeks, Beijing has pushed through numerous regulations and policies which have been designed to shore up China's data security. President Xi's data vision has always stressed control. In 2013, he said that whoever controls data has the upper hand. A year later, he said that control of information has become an important aspect of the country's soft power and competitiveness. So really, the hardening of China's legal regime around data usage has caused severe disruptions for multinationals who are operating in China. Large Chinese corporations and financial markets. Some of the laws, so the Personal Information Protection Law, which is due to take place in November, does stipulate that the data being moved out of China must either pass a security assessment or obtain another form of official approval. But for China, it's all about national security. First and foremost concern is that Chinese data must stay in China. As far as the antitrust aspects are concerned, China's going to ban its internet platforms from a wide array of behaviour, which is deemed to harm market competition. It's released draft rules which will ban unfair competition among internet companies, and that could come into force this year. Its market regulator has demanded rectification from dozens of internet companies. We saw Alibaba was fined a record $2.8 billion in April for abusing its market dominance. And those measures do target practices such as false advertising, fraudulent online reviews, unfair competition, data protection, and consumer privacy issues. Only draft rules been released so far, which may be revised after the consultation period. But actually, again, you can take a step back and say, are these generally not good moves which help the consumer? Actually, I think it's entirely possible to argue that they are. Now, with all that fear about the regulations and their impact on private enterprises, we do need to remember that the private sector is still an integral part of the Chinese economy, and it would not be in their best interest to decimate the sector. So too, I don't think there's an intention to broadly undermine the internet sector. The private sector remains a key pillar to China's growth and still represents over 60% of GDP and over 90% of employment. The importance of the private sector was also reinforced recently with the announcement that China's going to create a new stock exchange in Beijing, which is designed to become a primary platform for serving those innovation-oriented small enterprises. And that announcement came directly from President Xi, which reinforces that long-run campaign to try and develop their onshore capital markets. In broad terms, China wants to increase the size of the pie and allow a more equal distribution of rewards. Key to changing the regulatory framework is to promote healthy industry growth and efficiency. They're not necessarily all bad moves, albeit the market's getting a little bit concerned about the scope of them. Tech companies, I think in particular, seem to be responding to that new social and regulatory backdrop in two ways. Firstly, they're increasing their geographic diversification as far as they can, given the national security implications. And B, there is an element of appeasement by increasing their personal and corporate distributions. So here we're just showing that Tencent, it's increased its investments in overseas startups more than sevenfold this year. The company struck 16 deals in Europe and 34 international investments in the first 6 months of 2021. That was compared to 4 and 3 deals respectively in 2020 and 2019. Tencent emphasized its contributions to Chinese society, which is said in August, it set aside 7.7 billion for that common prosperity program. It's deployed facial recognition to protect and police young people from playing online games for long hours. Automaker Geely said it plans to award its employees with stock awards. Alibaba's pledged 15.5 billion for a social responsibility program, and that flood of donations that we're seeing are going to mainly go to state-backed initiatives. 5 of China's best-known tech billionaires have also pledged 13 billion of their personal or corporate fortunes, are really to try and boost charitable initiatives in recent months. So the tech sector is responding. But clearly, again, China's transition from unstructured capitalism to sort of more inclusive capitalism, we can put it that way, and that pursuit of common prosperity might have some longer term implications for investors, but arguably those could be positive developments. And they could include sort of a rising importance of ESG, so issues like labour rights, environmental impact, consumer rights protection, and equal opportunities. They could also unleash sort of massive consumption power, addressing some of that income inequality and focusing on common prosperity could accelerate China's transition to that middle-class society and a consumption-led economy, which will create new opportunities in consumer services like dental care and leisure. And actually, big tech might actually survive and thrive. So both as a key to economic growth and actually as an important source of technological innovation. Some of China's big internet platforms that focus on enabling and empowering China's consumers will continue to, I think, to play a crucial role in that strong and sustainable earnings power. So we're not saying that everything is right in China, but actually I think some of these motivations are to be welcomed. If we look at briefly in terms of what's going on in the economy, I think the major issue at the moment is that China is currently adopting a zero tolerance COVID policy, which is having an impact on economic growth. Its vaccine program is proceeding at a fast pace, and while the efficacy of the Chinese vaccines might not be as high as some other alternatives, it's certainly a better course of action than might be being followed by some territories like Australia and New Zealand. Again, taking a step back, China's target is still to double the size of its economy between 2020 and 2035. To achieve that, it still has to grow around 4.5% to 5% annually for the next 15 years. And that can really only be achieved with more developed capital markets and with a vibrant private sector. But it's got to be acknowledged that the regulatory tightening does present a bit of a fundamental and a bit of a lasting challenge to certain businesses that contribute to growth. The difficulty, as far as the Chinese are concerned, will be balancing that act, keeping growth high while trying to maintain that sort of social and national security agenda. So as mentioned, we've got a sort of weak and steady recovery in consumption that's holding back China's economy in the short term. But actually the problem is less to do with a lack of money, and it's all about caution. So spending here sort of lagged income growth over the first half of the year, even in regions that haven't experienced those COVID flare-ups. China's real household income has returned to sort of near pre-pandemic levels, but consumption, particularly of services, still has a long way to go. And sporadic outbreaks have hurt incomes and spending, particularly in those affected areas, but efforts to contain the outbreaks really by limiting distance sensitive services and non-essential travel do appear to be dampening the mood as far as those or beyond those virus hit regions. China's, I think, monetary policy has gone through several stages since COVID struck. In January, February 2020, it was all about crisis fighting. There was some growth support more between March and July of that year. Between August and August last year and June this year, it's been about trying to return more policy normalization. But really from July onwards, it's more about renewed growth support. The People's Bank of China has announced a recent 50 basis point cut in its reserve requirement ratio, again marking that return to growth support. As far as the latter is concerned, China is increasing its policy support really to try and head off any sharp loss of momentum as the economy has hit those new obstacles. But some of those, I think that monetary and fiscal support that's going to be offered is going to be proportional to the growth challenges faced. It's not going to be a shock and awe aggressive response. It's going to be measured, and it's about managing a slowdown, not about turbocharging growth. And certainly those cyclical policy, I think those cyclical policies are going to be turned towards longer term objectives, not short-term growth wins. The big question is, what sort of discount should we be applying to Chinese stocks given that regulatory uncertainty. Hints, I think, of any softening and restraint could help drive a rally in Chinese stock markets, but it's going to remain very much a stock pickers market, I think, in which you really want to aim for those policy favored sectors. They're going to be that safe haven. Some investors do appear to have become a bit more sort of cautiously optimistic, certainly around some of the cheaper valuations that we're seeing, that better transparency and compliance in the regulatory affected areas. But I think it's probably reasonable to expect that China is going to underperform emerging markets over the medium term. When we're working through the numbers, I think a realistic worst case scenario is a further sort of 15% fall in China's stock. The other, on a more positive note, I think, again, while there's been a lot of negative sentiment around the tech sector, I think we also need to remember that companies like Alibaba and Tencent do have large moats. They've got large protections built into their businesses. They've got profitable core businesses, and they've got very sort of high growth subsidiaries. And actually, tech giants, I think, will benefit from that shift towards greater consumption, which is embedded in that common prosperity agenda. And actually, that regulatory crackdown is ironically going to make it much more difficult for smaller firms to challenge those giants. And the closure of those regulatory loopholes and sort of that top-down security means it can be impossible for new challenges to grow as rapidly across as many different sectors as companies like Alibaba have done. Just looking at some discounts in terms of Chinese stock market at the moment. So valuations, the absolute forward PE ratio for the MSCI China is trading around 15 times. That's a discount to the 18 times for the FTSE All World, and certainly well below 22 times that you're paying for the S&P 500 right now. So certainly the market is cheap. Although, having said that, the forward PE ratio for the MSCI China is still well above its average range for the past 15 years. It's only just back below that one standard deviation above average. So we say valuations come in, they're not screaming that the market is outstanding value at this stage. Here we're just taking a quick look at the sector valuations of the MSCI China. We're looking at valuations at both the end of 2020, their current level, and where they were for a 3-year average. So that impact of common prosperity and the data sovereignty measures on company profits and equity valuations, those valuation impacts will ultimately depend on the extent to which any new laws are imposed. But if you're looking at this, you'd have to say, consumer discretionary and healthcare stocks could be the most vulnerable moving forward. Actually, I think moderate declines elsewhere are certainly probable too. And actually, most of the growth sectors in China trade at valuations in excess of the global average, despite that recent collapse. But on the other side, China is still amongst the fastest growing of the major markets, and it's got the scale, it's got the complexity, and it's got the income level to support equity valuations above global averages. Looking at investment opportunities, which I think are sometimes forgotten, Beijing's ambitions are to embrace self-sufficiency in areas like semiconductor manufacture and software development. I think, again, both could benefit from policy tailwinds. So in broad terms, you want to be invested in areas which are important to the Chinese authorities, or where there's going to be a light regulatory touch moving forward. So it's in areas like semiconductors, in areas like AI, cloud computing, or 5G. You want to be probably avoiding those areas which are likely to be the focus of regulatory focus. So areas like housing, healthcare, and education will, I think, still be areas to avoid. So summing it up, again, I think it's possible to put forward a less extreme and concerning view about the regulatory changes which are happening in China. Certainly some of the developments are to be welcomed from a Labour perspective. We're not arguing that China's approach to regulation is right, and certainly again some of its approaches to human rights leave a lot to be desired. But actually, in respect to some of these developments, some of those aims and objectives actually are to be welcomed and could actually contribute to a more stable society and potentially enhance the economy's long-term growth prospects through growth in the middle class and consumption, while at the same time addressing some of the imbalances which many critics have been quick to highlight. I think China is probably going to continue to be under pressure for the potentially the next few months, but certainly I think if the market would fall a further 10 or 15%, it's likely that we'll be looking at China a bit more positively, because I think at that stage the market would have fully discounted some of those regulatory moves. So that's China. Just quickly to move on to US inflation, because again, it's one of the major issues going on in terms of financial markets at the moment. Now, why is that? Because ultimately, if inflation remains low and inflationary pressures prove to be temporary, then the US Federal Reserve will be very patient in removing monetary stimulus and raising interest rates, which means that one of the key pillars of support for the equity market will remain in place. The problem is that if inflation becomes a problem and it's higher and longer lasting than hoped and expected, then the US Federal Reserve will need to begin removing the stimulus far more quickly than is currently expected. Bond yields will rise, and I think it's reasonable to expect the US stock market will not respond positively. So what we're going to quickly do is look at two things. First, we'll look through the inflation picture as it stands, and then we'll have a look at some of the factors which will dictate whether we think the inflation is indeed likely to be transitory, and then have a look at some of these stock market implications of the inflationary backdrop. This just looks at the picture over the longer term. To highlight, I began work here into the early 1990s, and I haven't really known US inflation to be a problem. Yes, there have been periods of higher and low inflation, but broadly since the 1980s, inflation has been contained until now, it seems. So this is the core PCE, which is the Fed's preferred measure of inflation. The figures you'll see quoted most often relate to the CPI, but the broad picture they show is broadly the same thing. That after 30 to 40 years of inflation being very well contained and very often below the Fed's target, there's been a sharp uptick recently. And this has really challenged the Federal Reserve's argument that the burst of inflation pressures and really accompanying that economic reopening will prove to be temporary. We've seen CPI readings which have remained in the 5.3 to 5.4% year-on-year area for the past 3 months, and even stripping out volatile items like food and energy, core CPI rose to 4.5% in June. It's moderated to about 4% year-on-year in August. Inflation has been most notable in the reopening components. So the price of airline fares and hotels has surged. Similarly, the price of used cars and trucks were up over 45% year-on-year in June, although that slipped back to just over 30%. Your car and truck rental prices are still up 50% on the year. And again, if we're looking at those those areas like the new and used cars and trucks, rental prices, hotels and airline fares, those factors are about 12% of core inflation, but were responsible for almost 2/3 of June's increase. And the view of most economists is that the upside surprises which we've seen in inflation numbers are as a result of transitory reopening factors and don't mark a secular change in inflection. So last year, rental car companies needed to sell off their fleets to raise cash. They're now rebuilding their fleets, and therefore prices are going to rise, but they'll slow once they've rebuilt those fleets. New car production, as we know, is being impacted both by better demand and also supply issues. But once those bottlenecks get resolved and semiconductor shortages ease, again, that should begin to sort of work its way through the inflation picture. And similarly, that increase in airline fares will settle once staffing issues can be resolved. The problem is, even if some of those transitory items are excluded, so here you're looking at CPI, taking out food prices, taking out energy costs, taking out used cars and trucks, we can see that inflation is still at its highest level since 1993. There are other ways of looking at core inflation. The index has got many components. Here we've just looked at what's known as the Atlanta Fed's sticky price consumer index, which is a weighted basket of items that change prices relatively slowly. It increased 2.6% over the year. That compares to 13.7% for the more flexible measure of CPI, which is a weighted basket of items that change prices relatively frequently. So the absolute levels here, certainly in terms of the sticky price, aren't that concerning, but they are higher than we've been used to. But that's kind of the past. We need to look at what the market's expecting moving forward. This shows what the market's expecting for inflation in the US over the next 5 years. So 2021 to 2026, which is the orange line here, and for the 5-year period beginning in 5 years' time, which is 2026 to 2031. The most intriguing is the five-year break even. This is the Fed's preferred measure of inflation expectations. We can see that it did rise sharply, and certainly in May it stood at its highest level since 2014. It has fallen back recently, but unlike the 5-year break even, it isn't significantly higher than its previous peak, and it's still around still under 2.5%, which suggests the market doesn't believe that inflation is going to get out of control and that inflation will be temporary. But actually that level of break evens is going to be very important to monitor, and certainly the spread between these two measures is also crucial. If this line, if the 5-year forward break even overtakes the 5-year again, and the spreads return to levels seen earlier in the decade, that's going to be a bad sign as far as the Fed is concerned, and certainly put a lot of pressure on them to change course. So that's what's happened. We've seen what the market kind of expects, what's going on as far as the US economy, how's that impacting the inflationary backdrop. Well, again, as a result of the lockdown and being eased in combination with the ongoing vaccination program, we've already seen some very strong economic growth numbers. So 6.6% growth in the US in the second quarter. This shows the US ISM manufacturing index, which in March registered highest readings since the early 1980s and is still extremely elevated. We've probably already seen peak growth in the US, but it's peaking from a very high level, and it certainly remains solidly above trend, which is a good thing. Actually, when we take a step back, more growth, lower unemployment, more money circulating around the economy, and a fall in the direct support which needs to be offered by the governments. It's getting us back to some sort of normality. But we also need to have a look at the labour market, and this is where things get really challenging to try and reach a conclusion. Actually, I think the time to really worry about inflation will be when the labour market starts to overheat to the point that a sort of wage price spiral erupts. That's not, in our view, a near-term risk, but that could happen potentially in 2 to 3 years' time, which might actually at that stage set the stage for a period of stagflation, so low growth and high inflation, potentially in the second half of the decade. Really, it's the state of the labour market which is the key uncertainty. So although the headline unemployment rate has come down by over 9% from its peak, I think it does overstate the healing which has occurred. 22 million people lost work in March and April 2020. Now, 2/3 of those jobs have been recovered, but we're still in a situation where around 5% fewer Americans are employed now than they were at last February's employment peak. And you can look at this in one of two ways. You can say that while the number of workers is still around 5 million lower than its peak, it's much better than the 22 million job losses that we saw in April. But you can make the other point that while US growth and the size of the US economy is back to around its peak level, jobs aren't. Non-farm payrolls had a pre-pandemic peak of 152 million. We're at 147 million. And again, that's one of the uncertainties as far as the inflation backdrop is concerned. But at the same time that unemployment is still high, unemployment is still lower than it was before COVID, most companies are still reporting it's very difficult to hire suitable workers. There's very nearly one open job for every unemployed worker. And according to the National Federation of Independent Businesses, 50% of firms are reporting they're having difficulty in filling vacant positions, which is the highest sort of share in the history of the service. And again, this begs the question, well, why is unemployment high at the same time that companies are reporting they're finding it very difficult to find workers? I think one of the key ones is that unemployment benefits were still and are still extremely generous. And actually for most low wage workers, the benefits they were getting from being unemployment were surpassing what they might be earning while employed. So therefore, it's not surprising that labour shortages are still quite pronounced, and certainly pronounced in sectors like leisure and hospitality, where average wages are relatively low. I think the good thing for struggling firms is that some of that disincentive to work is largely going to evaporate this year when some of those enhanced unemployment benefits begin to expire. That combination of potent demand and constrained supply isn't actually producing wage inflation. So this is just looking at Atlanta Fed's wage tracker, which follows the same set of employees over time. You can see it kind of rolled over, but it's now near, it was well below what we saw post the financial crisis of 2000 and 2008. There's been a bit of pickup recently, but we're still well below levels, which we'd say is a real concern as far as wages are concerned. And then we've got the issue of ongoing supply chain disruptions. Global semiconductor shortages, which is leading to factories struggling to match demand. What are they going to do in that sort of scenario? Logically, they're going to raise prices. Again, that seems that situation is going to be with us for a while. Back in June, the Fed did jolt markets slightly by signaling it might raise rates twice in 2023. But again, I think the key message here is that actually the US Federal Reserve is going to be very slow at raising interest rates. They are very conscious of the fact that they don't want to undermine the recovery. They're looking at two things in terms of raising interest rates. One is that inflation is going to be above 2%. I think arguably that is going to be the case, but certainly the employment picture isn't quite as vibrant as they want or expect it to be moving forward. Turning and then just looking at the real Fed funds rate, we need to understand that actually at these sort of levels, the US interest rates are still very accommodative. Even if the Federal Reserve begins to raise interest rates, they've got a long way to go before interest rates will be back in restrictive territory. And then finally, just to wrap things up quickly, just to have a look at what's going on in markets. It's been a very good year. It's been a very strong year for financial markets. Most assets have made money. Clearly, the standout underperformer, as far as that's concerned, is the Chinese stock market, which has lagged. Some of these charts, if you've heard us before, you'll be familiar with. The US stock market is looking very expensive by most historical valuations. So certainly if you're looking at PEs, it's off its high, but 22 times the market, so the US stock market is not cheap. Price to sales ratio, well, again, the market is as expensive as it's ever been. The only metric by which you can say the US stock market offers any value is if you compare it to long-term interest rates. And that's why the market at this moment in time is so focused on the interest rate picture and by extension, what's going on in terms of inflation. Just to bring out a few other things, there's a bit of concern that when the US Federal Reserve is going to raise interest rates, it doesn't necessarily, just because the interest rates are going up in the US does not mean that we're suddenly going to see an end to the bull market. That's what is showing on the left-hand side here. This is the S&P's performance before, so minus 6 months before, 3 months before the Fed begins to tighten, and 3 months and 6 months after. On average, this S&P 500 has still made over 6% after the Fed begins to raise interest rates. And actually, again, we're looking at those returns going back as far as we really sort of can, looking at the equity performance during periods of rising real funds rate. It shows that actually overall the market is still quite strong. The average return of those 9 periods is over 12%. So again, that's good returns to be had. But if we're looking at sort of the price earnings ratios, historically 0 to 2% inflation, or actually a mild deflation, is the sweet spot as far as S&P valuations are concerned. If inflation goes up, then actually the price earnings ratio for the S&P 500 typically starts to decline. And bear in mind, in this case, we're coming from a market which is trading on 22 times, so it's already very expensive. But actually, when we're taking a step back, actually, do we think we're at the top of the bull market yet? No, we do think there's further room to go. Some of those warning signs that you typically see at the peak of markets are just absent at the moment. The only area we can say the markets maybe got a little bit frothy is in terms of the IPO activity. There was a surge recently, but actually some recent SEC comments have helped just to ease that off slightly. A few things going on in terms of growth and value, but we'll come on to those potentially during the Q&A. I think value stocks are the place to be for the next 6, 12 months. Value stocks, even given the fact they do trade at a cheaper level than the market, are offering better value than you would normally expect. So key messages, again, if you've heard us speak before, hasn't actually fundamentally changed. We do think the positives are the fact that vaccines continue to roll out. Monetary policy is very supportive, and policymakers have said that there going to be no rush to raise rates. The uncertainties as far as the markets are concerned are what's going on in terms of inflation and when the Federal Reserve might first begin to sort of raise interest rates, and the fact that actually a lot of the good news already seems to have been discounted. But I think actually there is still a tailwind for positive returns from equity markets. So with that, I will stop, and I'm very happy to take any questions which there might be.
There we go. Thanks a lot for that, Justin. We haven't had any questions in, so I don't know whether that's a good thing because you've been so concise in everything that you've said, which has been excellent, or whether it's a bad thing that people just haven't bothered writing a question in. So I'll let you answer that one.
I'll choose to take the positives from that. Obviously, again, the summary view is, I think, headline views. There's a lot going on in terms of China. It's not all bad, I think, is the major point that we'd make. I think it might act just to cap Chinese stock market returns. But I think if the Chinese stock market were to fall much further, we'll certainly be looking at it with interest. As far as the inflation backdrop is concerned, we do think that some of those forces are transitory. We do believe we're in the Federal Reserve's camp as far as that's concerned. I think generally we can still look for the next 6 to 12 months to being a positive as far as equity markets are concerned. We'll happily share these slides with everyone post the call. There's a lot of information we realise to go through there. But again, if anyone's got any questions, either Rich or I will be very happy to help and assist as we can.
Just a question from me, Justin. What's the biggest movement in your portfolios that you manage yourself at the moment?
Well, in terms of the asset allocation changes that we've been making, we've been fairly happy with our positioning. I think the major moves that we've made really over the past 6 months are just moving away from growth areas like technology and just increasing our exposure to those value areas, so financials, really just an expectation that actually what led stock markets in 2020 won't necessarily be the areas which lead stock markets in 2021 and 2022. I think tech stocks will be market performers at best, because again, at least partly on the Western world, tech stocks are going to come under increasing regulatory pressure, and that will be, the Chinese are doing in many ways what the Western world would love to do, which is try and control big tech a bit. They've got concerns about the monopoly which certain tech companies are enjoying. It's just the Chinese tend to do it in a much more brutal way than Western democracies do. But I think, value stocks, and I think the second leg of the bull market, which I kind of think what we're in, will just be led by other areas. So we've reduced our exposure to those areas, putting more in towards those sort of unfashionable areas like financials, which I think will do well over the next 6 to 12 months.
Okay, great, thank you. Still haven't had a question come in. Normally when I ask a question, it prompts other questions. But no, we haven't had one. Richard, have you got any questions for Justin? I know you see him every day.
No, I talk to Justin on a very regular basis, and that was excellent. And obviously, I'd just like to underpin how good that was, and how accessible we are in terms of providing opinions on the markets. And obviously, I've put in the chat function what our emails are. And if anyone wants to contact us directly, please do so. And obviously a shameless plug, we are managing 33 billion sterling plus of client assets, and Justin is integral to that process and our investment philosophy. So if anyone wants to contact us, please do so.
Excellent. Thank you very much for that. Okay, we'll call it then today, guys. Thanks for all that have attended. Thank you for your time. Hope you found it useful, as I know I did. And I will see you at the next event when we put it on. Thanks a lot, guys. All the best.
Thank you very much.
Cheers. Bye now.